I have absolutely no idea what the hell is going on.
Was that me?
I have absolutely no idea what happened. All I know is that I just looked at the screen and it disappeared. So I apologize.
I felt like Steve Urkel. I was like, did I just do that? Like, what did I do? What did I do? What did I do?
That was Jacob. Everyone's Jacob. Look how many Jacobs are on the screen.
There's so many freaking Jacobs.
At least it wasn't me. I thought I did something.
I don't know. We're signing Matthew on, and he got crazy. For some reason, he cannot seem to get on.
It's that high energy that Matthew has.
He ended us.
That's what it is.
He ended us. All right. So I don't know where I cut off, but I was talking about opening up that account. So hopefully you guys got all of that.
I have a question, please.
Sure.
Did my screenshot go through before it cut off? I put something of, just want to make sure that's what you were talking about. I think I opened up the wrong one the first time.
Okay.
Let me put it through again. I just want to make sure that's what you're talking about I did like a joint one with my husband, but
yeah, that's fine. If you do a joint one, it will still be one of those, like, it's an individual, but it's joint, so that's no problem at all. So if you and your husband are planning on trading together, though, and you're combining your money, like your assets together to trade in one account, that's perfectly fine. I would still suggest that you both open up individual accounts because you're going to paper trade differently, right? Your trading skill will be completely different from what his might be. So if you're using that one joint account, you only have one paper trade to trade with together. But you kind of like want to start to see how you develop as a trader if you're going to be trading, and how he's going to develop as a trader if he's going to be trading. So you can still do the joint and fund the joint and open up an individual account that's not funded, but it's just for you to log in and paper trade, if that makes sense.
Got it. Okay. Yeah.
Right.
So yeah,
use fund the joint account, because that's where you're gonna put the money in. But then also open separate individual accounts that you have your own separate login. He has his own separate login. That way you guys can paper trade individually.
Cool. Makes sense. Thank you.
You're welcome. All right. Any other questions on opening up an account? Nope. Okay, moving along. All right, let's see if I can get this. All right, so last week we kind of talked about, just the markets in general and what the financial markets were. And we really just stayed on that one instrument, which is the stock market. And we kind of said, okay, we're going to put the options market and the Forex market and the futures market on the side burner for now, because we're not going to touch that for now. So we're still just going to be focusing on the stock market. But just kind of like to recap what we talked about, the four market indexes that we follow or that we track are the S&P 500, the Dow Jones, the Russell 2000, and the NASDAQ. So to give you an idea of what those instruments looks like or what the ticker symbols are, let's open up this platform and start looking at them. And then I'm gonna be going back and forth between a Word document and the actual demo, just to kind of, give you guys both the written version and the show and tell, because I think that's kind of like how most people learn. They want to see something, but then they also want to like see an actual demonstration of it. So let's go to here and tell me if you can see my screen. Let's see, hold on. Wrong screen share. Did I take you back to the internet? I think I did. Let's go. Not that. Let's go. This. And this. All right, here we go. Share. Okay, hold on. Too many things open. Screen share. There we go. All right, here we go. So When we talk about the different markets, right? We talk about the S&P 500, we talk about the Dow Jones and the Russell and the NASDAQ. So these are what we call ticker symbols. So when you're looking up a stock or an ETF or any tradable instrument, you know, whether it's a currency pair or whatever, you'll start to learn what the different, what their ticker symbols are, okay? So when we talk about the S&P 500, this is the index or the ticker symbol for the S&P 500. So if you want to write it down, you can go S&P 500 equals SPX, and that's a ticker symbol right here that I'm highlighting over here. And this is what we just use to track, right? If you look at the value of S&P 500, it's sitting at 32.31. We hit an all-time high today. Woohoo! Market is still going up. So this is what we use to kind of track the overall market. This is not what we trade, though. We trade the ETF of the S&P 500. And that's what's known as SPY. So if you want to kind of like write it down so that you can kind of follow the format, let me see if I can do my little whiteboard here.
Can you just say that again? Because
Sure.
you said a lot. The S&P 500 is the actual index.
Yes.
And then,
So
but we
yeah.
trade, we buy and sell the SPY fund or whatever, however you want to call it.
Correct. So
Okay.
so how you want to do it is that you want to, so let me open up this Word document real quick and then we can kind of talk about it and then you guys can kind of see how. So let me stop share that and let's open up the Word document. And can you guys see my Word document?
Mm-hmm.
So if you want to go like market index, you can tab that market index and then you can tab that so you can say, okay, so the market index is the S&P 500. S&P 500, okay? The what we track, which is called the index, the indices, or what they call the indices, is going to be the SPX, okay? And then the ETF version that goes with it, what we actually trade, the ETF, is the SPY.
What does ETF stand for?
So ETF stands for Exchange Traded Fund.
Okay, thank you.
I was gonna guess electronic, but exchange is do.
Yeah, me too.
Nice guess, nice guess, nice guess. And then the Dow, or the Dow Jones Industrial, you know, they call it this, it means the same thing. Dow 30 or Dow Industrial is what we consider to be the ticker symbol for that is $DJI. Now every broker has it, may have a different ticker symbol for it. DJI, if I could spell. And the ETF for this is what we call the DIA, which stands for, it's like short for diamonds. They call them the diamonds too. So like you'll hear, and oh, let me do this. And they all mean the same thing. I don't know why investors, it's like the investors just nickname all these things, but they all mean the same thing. And sometimes people get confused as to what they are, but they all mean the same thing. So if you hear somebody say, hey, I own the spiders, that means that they own the S&P. If you hear them say, I own the diamonds, they actually own the ETF for the Dow Jones Industrial. NASDAQ and the ticker symbol for the index is NDX. The ETF for it is the Qs, also known as the Qs. Because it's QQQ, that's a ticker symbol. And then the last one is the Russell 2000. The ticker is RUT and the ETF is IWM. Okay, so this is what we'll be looking at when we start to reference. Now, when we look at the charts, I'll either pull up the index itself, but when we're trading, we'll be looking at the ETF instead. Because, and I'll show you guys why. Did you guys all capture that already?
No, wait, Russell.
Almost.
And I'll save these notes and then we'll post them up in the
Note section. Yep.
in the notes section.
Wait, what?
And we'll call this, this is session 2. Session 2, Investor Party. If I can spell today. All right.
So what is it, RUT?
Yep. And can you guys see that? Is that too small? Should I make it bigger? Make sure I make it more visible for you guys to see it. Which then messes all that up. Yeah, ready to go, Em.
There's no nickname for the NASDAQ and the Russell?
Well, they're called the Qs. Like somebody might call them the Qs.
Okay.
Yeah. And then the Russell, sometimes they'll be referred to as the small caps.
Oh, that's the small caps. Okay,
Mhm.
that I know. All right. Okay.
All right, so going back to the charts here, part of your daily routine will be to look at and see how the market did in general, right? So once again, we use the S&P to track the entire market because it's the top 500 companies. But here's a ticker for the Dow Jones, which is the $DJI. And the Dow Jones, if you're just comparing, just to kind of see which index is leading the market, if you just compared all 4 and you looked and saw, okay, this is the S&P, I mean, this is the Dow Jones. Look at where the price, just look at the picture, right? This is where we are at the all-time high back in February, and this is where we are now. So the Dow Jones, if you are comparing the Dow Jones against the S&P 500, the S&P 500 is what we consider to be outperforming the Dow Jones because the S&P 500 just hit an all-time high, while the Dow Jones is still trying to play catch up to where it was at its highs back in February. Now, when you compare both of these to the NASDAQ is way outperforming both of them because the NASDAQ cleared those highs from February back in in June, right? So the NASDAQ tech industry, right, is definitely outperforming the entire market when you look at where it is today compared to where the S&P is and the Dow Jones. Now, your small cap companies, and let me clean up all these lines so that you guys can just see.
I'm gonna ask questions, okay?
Go right ahead.
Because you're saying a lot, and and I went to college and I've heard this. So first of all, you made a remark about the NASDAQ. The NASDAQ is where the tech stocks trade.
Well, yeah.
So you're gonna find Apple in that grouping.
Yes, because it's an index that tracks tech companies, right?
Okay.
So
right.
it has a lot of tech companies in this index. The S&P is also going to have Apple in it as well, but the S&P is a basket of other sectors as well. It's the S&P 500, so it's all the other 500 companies as well. NASDAQ is going to be heavily weighted on tech. And the Dow 30 is just those 30 industrial companies.
Just
right?
30 companies. And the S&P is 500 companies from different sectors that make up what they feel is the economy.
You got it.
And then when you said the Russell's, the small cap. So
Right.
what defines small cap versus large cap?
We're going, so it's the value of the company, right? Not the
Okay.
price of, not the price of the, not the price
stock
tag,
price.
right? But
It's
the
the
value
valuation of it.
of the company,
Okay.
exactly. And we'll get into that when we get into the fundamentals of companies and how we look at companies
Sure.
and evaluate them. But yes, that's what defines them. So your small cap, the small caps will be like, you know, those smaller companies compared to like your, you know, your Apples and your Amazons and those other high, you know, high flyer companies.
Hey, Em, can I add something here? Hey, guys.
Oh, Jakey, hey, how are you?
Yeah, showed up. When we talk about NASDAQ being tech, the reason for that is because the NASDAQ was the first fully electronic exchange. So when a lot of these companies had the opportunity to list, they could go on New York, but they said, no, let's go electronic. So when you're trading in the example, the NASDAQ 100, it's the top 100 holdings on that exchange itself. So it's just heavily weighted in tech. So I looked it up. I remember back in the day, in 2016, it was 56.26% technology sector weighted. So again, the majority, over half, was that sector. So it's why we a lot of times think about it. And if you ever follow CNBC Business, they usually do not quote the NASDAQ 100. They'll talk about the composite. There is a separate index called the composite, which is the entire exchange itself. So not just the big dogs, it's everybody, right? So there's two separate things there. We just really look at the high flyers because the majority of this market move as of recent has just been the high flyers. Like the majority of S&P 500 companies are still trailing below their 200-day moving average. There's just a few companies really that are outshining and pushing everybody higher. So.
Thank you, Jake, for your input. I appreciate it. Any other questions?
Yeah, are you on Thinkorswim right now?
Yes. So this is the Thinkorswim desktop version from TD
Yes.
Ameritrade. So I guess what I failed to mention when I was showing you guys that the way of opening up the account, once you do open up the account and you have a username and password, you do want to just go to like Google and just type in Thinkorswim download and then actually download the software. And then once you download the software, it will be like an icon on your desktop and then it will pop up. So sorry if I did not mention that. So once you create an account with TD Ameritrade, then just go download Thinkorswim, and it's just a quick search on your website.
I found it.
You got it? Okay. And then just download it.
Thank
Once
you.
you download it, so, and I'm pretty sure this is still the way you have to do it to activate the paper trade, because I have not had to open an account with them in a while. But you have to log in, and let me see if I can show you that demo real quick. You have to log in on the live account first to activate the paper account. So let me see if I can do that for you guys so you guys can see it. Share. So I'm going to log out and then I'm going to log back in, and let's see if we can. And let's see if we can open that up again. All right, let's go back and share. Let's see. Where's my startup window? Oh, okay. Now Thinkorswim wants to install updates, so it's taking a little while to come back up. But I wanted to show you guys like just on the initial login page. Let's see. Let's see if it will come back up. I hope I did not just, oh, there we go. All right, so So when you go to log in, whatever your username is, you'll type in your username here, and then you type in your password. And you see how when I toggle back, what the live account will always show in green, and the paper will have like this kind of like yellow brownish color. You guys see the difference when I toggle back and forth? So in order to activate the paper money, you have to log into your live account at least once. So you would go in, put your username, password, and log in. And then you can immediately just exit out and then relaunch the software again. And then this time, click on paper money and then type in whatever that username and password is. And then that will activate your paper money. And then from there, you can start to use the app. And let me relog back in again into that. And then go from there. So that's how you open up the Thinkorswim software on that. Any questions on that? Nope. All right. So what other homework did you guys have? To go open up the podcast and at least start listening to podcasts. Did anybody listen to the podcast?
Yes.
Yeah. Anything you want to share on what you learned on the podcast?
That's all I said. Like, yes. Yeah, it was I listened to it was 3 hours. It's a lot of ones.
Yeah, it's a
I
lot.
fast forwarded to the currency part. It was really interesting, the history. I actually found this other podcast. It's called Beginner's Guide to Investment, which I don't know if y'all recommend it, but I've been listening to it since last week, and it's like 20-40 minutes each, and it took a lot of what we talked about, but also other stuff that I missed, I guess. And it helped me too. It's just called Investor for beginners. And that's what I've been listening to. I think that's pretty sweet.
Cool. Cool. Yeah. So again, it's just for you guys to just get immersed into just the lingo of investing and trading, because it's just the terminology can get a little bit tricky. But if you can just spend a couple minutes a day, half an hour a day, an hour a day, or whatever, just kind of like immersing yourself into the lingo of things, and it will start to make sense the more and more you keep immersing yourself into the markets. But what I want to talk about today is kind of like the psyche of trading and investing. One of the things that people have, or the common mistakes that people make, is just based on what they themselves have experienced, or what they've heard other people talk about, right? So, you might hear somebody say, oh, trading is risky. I lost, a whole bunch of money. And then that becomes your truth when you haven't even traded yet or invested yet, and you have no idea what that experience is like because you haven't gone through it. But that becomes your truth because somebody else said it, right? Or somebody might say, oh, the market is great. And then you have this excitement, about it because you heard somebody else have a different, a concept on investing and trading. But there are really two things that drive the market, right? When we talk about in terms of like emotion, who wants to take a guess as to what those two emotions are?
Fear.
Definitely. And what's the other one? What's the opposite of fear?
Elation, I guess. I'm not sure.
So that would be greed, right? So those are
Greed,
those are the two things that really just that drive the market when you think about like just the emotions of the market, right? And on the fear side, like obviously somebody has a fear of losing money or a fear of missing an opportunity, those types of things, and it leads you to make poor decisions if you have that kind of mindset. And the same thing with greed, when you have that greed of like, oh well, initially you are okay with making, $10 on that trade, but then you're telling yourself, well, $15 is better than $10. I'm just going to stay in and try to get that other, $5, right? And Jake is shaking his head.
So I want to hop in on here. Guys, let's make this a lot, in my opinion, a little bit more simplified for my brain. Emotions. Emotions are the hard part, guys. That's it. I mean, like she said, what'll happen is you write down on your piece of paper, I'm going to sell when it gets to 100. And when it gets to 100, it's doubled. And you're like, oh my gosh, I made all this money. What if it doubles again? And you get way too caught up into it when you shouldn't. So the number one job of a trader is to eliminate your emotions. And everything that we do is more mechanical, less emotional, right? That's kind of like a little mantra I say to myself: more mechanical, less emotional. Make it like an old timey cog and wheel, right? So everything fits together. There's not many moving parts. That's ideal. So there's very specific things that we do in order to limit those emotions, right? So for example, I'll give you guys one. So if you're taking notes, I'd start writing. Number one is always have even sized risk. Even, which means if you risk $200, you risk $200 every single time. You're not more emotional about one versus another, because as soon as you go heavy on one position, you care more. So if you have 2 grand invested over here, you have 1,000 invested over here, it's gonna mess up the math, because trading is a series of random results that create long-term predictable outcomes, and you don't know the series it'll come in. So you got to make sure that it's always even size, right? So that would be, I'd say, number one. Number two for me, and I'll give it to you, Em, I'm sure you have a few more, is write it down. This might be super simple, but if you are building a trade for the first time, let me share a screen here real quick, Em.
Go right ahead.
I'm sorry, I'm commandeering for a second.
You're
Can you guys
welcome.
see a little white screen by chance?
Yeah.
Got too many monitors. All right. This is what I used to do. I would draw out every trade. I'd draw it out and I'd write in my prices. All right, I'm gonna buy at whatever the price is, the ceiling over here was 100, this floor was 90. When it gets up to 105, I'm gonna sell. And I write it down so that when you go back to your paper, you can see it in front of you. Right. So I'd have these scrap papers everywhere and I'd put them in a little pile. And that was my system. Everybody has their own. Right. But whatever you do, write it down so that when you get all emotional, what'll happen is it'll be at 105. Your brain will be like, oh my gosh, I just made 5 grand. It could be 10, and it's too easy. And you're like, let me just let it go a little longer. But you come back and you say, nope, I wrote it down. It's right there. I got to get out. So that's what I would do when I'm new. Eventually, you can keep a spreadsheet, and you can get them hooked up with that. But the more of a system that you make it, and I used to tell all my students back in the day, you should be so detailed with your trading and investing plan. It's like a little book. It's a business plan. If you hand it to your niece who's like 13, 14, she should know exactly what to do. I risk X amount of dollars per trade on every trade. I have this many trades going on. Let's say, I'll give you some examples. I'm going to put 10% of my account in one trade. I'm going to have 8 trades on at all times. I'm going to be risking 1% of my account per trade. I'm going to be making 2 trades every trading week. Right? Like, you literally kind of write it out so that every single step is known, and then you can act upon it. Right? So make it whatever you want. And I'll give a bunch of examples if you guys want to know what different ones look like. And M trades different than I do. But have it all written down, right? Have it like a little book in front of you. This is what I do. These are the trade setups that I trade on. For example, maybe you're a retracement trader. You like it when it pulls back before it pops. A lot of people trade like that. Some people just want to be breakout traders. So when it breaks out of new ceilings, they want to trade those. What types of setups are you looking for? What stocks are you trading? I'm trading only under $50 per share stocks, for example. That's fine, right? But have those things figured out so that it's more of a very specific business, and you're identifying the niche of the market you're trying to attack and not trying to do everything. You'll be, in my opinion, far more successful. So one of the last thing I'll say here, and then I'll give it back to you, and trying to keep these emotions at bay, is one thing that I do besides having a trading plan is I have a trading partner. So Emily, when she logs into her accounts, she sees my account. So that's a little fail safe in my regard. So if I ever start going crazy and I start doing things that I shouldn't be doing, way too much money in one trade, letting trades run longer than they should. I have somebody looking over my shoulder to say, hey, what's going on? Make sure stay with the plan. Stay with the plan, right? So eventually that's something else that you could kind of maybe add in as well. So.
Yep. And yeah, and what Jake just said is the opposite of what most people don't do, right? The common mistakes that a lot of people make when they first start trading and investing is that they trade on emotion and they trade without a plan, right? So you absolutely have to have zero emotion when it comes to trading. You cannot love one stock more than you love the other, right? Matt, our instructor, you always used to compare his kids. He says, I love all my kids equally. I might like one over more than the other, but I love them equally. So when it comes to trading and investing, it's the same way. You can't have a $10,000 account and have $9,000 in one trade and then $1,000 in another trade, right? That's how you blow up an account easy. So it's having a trading plan where you know exactly where every dollar amount is going to be allocated to which stock, and having no emotion. If you have rules, the rules will eliminate you having those two emotions of fear and greed, because you'll know exactly where to exit, you'll know exactly where to take your profit and exit the trade if it's not working for you. So just just always make sure that that's the one thing that if you want to keep trading for a long time, is to just have those two things in place: money management, how you allocate your money, and not getting emotional about your trades. If you take a loss, move on, and go from there. So so the next thing I want to talk about is just like what the four core investing, 4 cores of investing. I want you guys to write this down, and then we'll talk about them individually. So the first thing we look at is fundamental analysis. And just in general, what fundamental is, it's like almost like looking at the report card of a company. And this is where you were talking about how you evaluate companies and earnings and that kind of stuff. And we'll talk about that here shortly. But fundamental analysis is kind of looking at the company and just seeing how the company is run. Is the company making money? Is it losing money? Who's the CEO? And all that good stuff. And then the next thing that we look at is technical analysis. Technical analysis is the visual, right? This is where we look at charts and candlesticks and determine, okay, what is, where is the price at today? Is it going up? Is it going down? Is it going sideways? What's the deal with that? So number 1 is fundamental analysis. Number 2 is technical analysis. Number 3 is cash flow. And cash flow is more like, you're looking for like, ways to make money, obviously on a consistent basis by either, trading stocks, options, futures, Forex, but it's not just buying something and just waiting for it to go up. It's actually now incorporating the concept of cash flow and making money from the markets. It's just having posture in the market, right? And then the last thing is risk management, or you can also call it protection. So once again, fundamental analysis, technical analysis, cash flow, and risk management or protection. And risk management, and I don't know if you would have rated, because a lot of people always like go back and forth, and you'll have people who are very, very fundamentally driven, right? So they look at fundamentals and that's how they make the decision, and they say, well, technical analysis doesn't matter, nothing else matters but fundamental analysis. And then you'll find somebody else who's very technically driven and just looks at charts and goes, well, fundamental analysis doesn't matter. It's all about the picture. It's what the company, it's what the stock price is doing, right? And you have a lot of back and forth. So just think of think of fundamental analysis and technical analysis as just, people on 2 different sides, right? And they're just kind of going, like if you just had like an analyst coming on TV and you have one arguing one side and you have one arguing another side. The idea when it comes to you in trading is that you want to have it balanced, right? And the way I look at fundamental analysis is the longer you're going to be in the trade, the more you need to know about the company. Does that make sense? So if you're planning on holding on to that stock for, you know, a longer time frame, then yes, whether the company makes money or not matters. You know, who the CEO might matter. You know, what their plans are, whether they're making money, losing money, that might matter the longer you hold on to a trade. When you are planning on just being in a trade for a short while, then what matters more will be the technical analysis, because you're looking at the charts to help determine when you're going to get in and when you're going to get out, take your profit or take your stop loss, right? So that's kind of like how, when I think about those two, like if I'm finding myself just kind of going back and forth as to what it is I'm looking at, whenever I'm going to hold the stock for a longer time frame, then I'm going to look at the fundamentals a little bit longer, and that usually falls on that category of your, you know, you're investing, right? You're putting on that long-term investor hat. And then with the technical analysis, you're more or less, you know, that's where you come, you know, your day trader will come in, your swing trader will come in, and because they're planning on holding it for just a short time, they're in and out. Okay, so that's fundamental analysis, technical analysis, cash flow, and risk management. So fundamental analysis, let's talk a little bit about that. Any questions so far? Yay, no, yes, no, maybe?
Makes sense so far.
All right, perfect. So when you think of fundamental analysis, right? When you, in terms of like a corporation, right? This is where we want to see the ins and outs of a company. And I'll compare it to like real estate. If you guys are going to buy a home, right? And your agent takes you out, you look at a couple of properties, you know, the next thing they'll give you, if they haven't given it to you already, is comps, right? Because you want to compare it to the other homes in that neighborhood to see whether that home is priced right. You want to be able to understand, see whether the house is overpriced, underpriced, or right in the middle. It's the same thing when we look at fundamental analysis. Now, there are a lot of things that come into fundamental analysis, and we're just going to focus on one, which is called the PE ratio. Okay, what the PE ratio stands for is price to earnings. So once again, PE ratio stands for price to earnings. There are other things they look at, such as like PEG ratio and debt to equity ratio and other things that I have not even learned yet. But the one thing that a lot of that we're going to start with is just the PE ratio and also earnings, right? So you guys have heard me talk about earnings all the time, in terms of when companies reports its earnings, this kind of, you know, when they tell us whether they've made money, lost money, and that kind of stuff. So price to earnings ratio is what a lot of people will look at to kind of just gauge on what the company is doing and how the company is doing. So it's almost like a ranking per se. So if, you know, back to the comparison of the real estate, when you guys then when you guys look at the property and then you get the comps, you make a decision based on the comps, right? So if you offer, if the house is overpriced, let's say the house is selling for like 500K, that's the asking price. But then, you know, the comps in the area are showing that the houses really are going for like, 450 or 425. Well, then that house is overpriced, and you'll want to know why the house is overpriced. So maybe this house has, you know, a pool versus the other houses in the neighborhood don't have a pool. Or maybe that particular house has, you know, the upgrades of all upgrades when you think in terms of like, you know, when people remodel their homes and so on and so forth. But when you as the buyer make that offer and pay that price, you know going in that you are paying for an overpriced house, right? Because you've done your due diligence, you've done your homework and compared the other properties. If you get the comps and the price, the house value is, you know, they're listing it for, you know, 500, and you know the area is like 550, then that property is underpriced. You want to know why that property is underpriced, right? You know, what is it lacking? Does it have issues? Is there structural issues? What's the deal that the house is underpriced? If the comps come in line, meaning that, you know, the house is, they're asking for 500 and the comps are coming in at 495, 505, whatever, then it's a fair value. You're paying whatever the market value is for that area. So it's the same exact thing when we look at stocks. A lot of people assume that the price of the stock is what actually determines the value of a company, right? So if you were comparing, for example, an Apple, right, versus like a Tesla, or Apple versus Amazon, right? Apple is sitting at $500 a share. Amazon is sitting at 3,200. Is Amazon better than Apple, right? Or for example, Tesla. Did Tesla hit 2,000 today? I think Tesla hit 2,000. Tesla sitting at 2,000 versus
It's coming
Apple
off 2000. It
coming
broke
off 2,000.
2000 and it was coming off.
Right. So, so if I were to ask you guys which company is better right now, is it Tesla at 2,000 or Apple at 500? What would you guys say?
And to clarify, you're asking better value?
Yeah, better value. Tesla at 2,000 or Apple at 500?
Do we know in this scenario? Sorry. Unmute yourself, Jacob.
Who was asking the question?
Oh, there we go. Do we know in this scenario that Apple just split their shares?
No, I'm just giving you the price. Apple at $500 a share, and Tesla at 2,000 a share. Would you know, just based on those numbers, which company is better?
I don't think so.
Right.
Wouldn't,
Yeah, you
wouldn't
wouldn't know.
Okay.
A lot of people make that assumption that, oh, the higher price stocks must have more value than the lower price stocks, right? Which sometimes it could be the opposite, right?
Can I go on a little rant here because for a second, I'm commandeering? Because this is something I find with a lot of new traders is that it's all just a big game, right? Apple is the most valuable company in the world, and pretty soon they're going to be a stock price of 100 something. They're magnitudes larger than most companies, guys. Like
It's
it
at
is larger than the
2.1
GDP
trillion.
of Germany.
Yep.
Yeah, like it is massive, right? Yeah.
So then it matters more how many shares they have too, right?
Yeah, so it's not just price. So price is half the picture, right? Berkshire Hathaway, hundreds of thousands of dollars for a share. Apple, small price, but they manipulate all that. So what you want to know is what am I getting for that dollar I'm spending, right? So PE ratios are a comparative metric to let you know how many earnings are they receiving when you buy that future growth, right? So I'm paying right now 30 years of what they're earning, right? Or whatever it may be, right? And you can make that decision. Maybe another company's 100 times their annual income versus one is 20, right? And you can kind of make that comparison and say, hey, one, I'll get my money back faster, at least in annual revenue versus another. I don't know where you're going with this, Em, but I want to give you guys some context. I'm gonna add something here, and then if I was ahead of you, I apologize.
No, go right
I
ahead.
want you guys to write down something. It's called a CAPE, CAPE, cyclically adjusted PE ratio, also known as a Schiller PE. They do a actual ratio for the entire marketplace. So remember, this is a comparative metric. Tech against tech, fair value. Like that's a fair kind of comparison, if you will. You know, consumer cyclical against consumer cyclical, right? You can use these types of metrics to do a lot, and you can even look at the entire marketplace, and it gives you an idea of what you're looking at. So if where was my screens? Dang, I thought I was all prepared. I had it up. It's when you have too many monitors. I'm watching dirt bike videos on one of them. All right.
Nice.
Oh, jeez.
Did you say cape? Like CAP? Like a
CAPE.
Superman cape?
Yep. Cape, you're perfect. Like Superman cape. Superman cape. Okay, I apologize. There it is. All right, let me show the screen.
Like that, people get.
Not dirt bike videos. All right. Schiller PE, right? This is the entire market, right? This is the S&P 500, if you will, adjusted for back in the time. What you'll find is that we're kind of overvalued over here, right? It's a high number. That's all you need to know, right? higher than it kind of has been in the past. So guess what? A lot of stocks are overvalued right now. It is what it is. If you're buying them at high prices. The mantra is hold your nose and buy. That's what we're doing right now. I mean, there's no other way to make money. But when you're using this, right, the entire marketplace has a PE of 31, but certain parts of the economy are trading at higher, more rich valuations than others. So what you can do is you can actually take this again and look at it by sector. And what you'll find is that real estate is currently the most I'd say overvalued sector of the market, right? You can see that's the biggest number at 46 on the Schiller PE versus energy. Energy's been crushed, right? Financials at the bottom, but you can see all the communication because everybody's excited about 5G at the moment. It's rich. Consumer cyclicals, right? Technology, Apple's, Amazon's, all of those are going higher. So guess what? If you want to buy them, you're paying a high price. But what this type of metric allows you to do, and traders don't use this, but investors do. So in your investing accounts, this stuff matters. If you go look up a company and you go look up an AT&T, for example, and you see that their PE ratio is probably in the, my guess would be 30. They've been hanging in the toilet recently, 18 actually. So what you'll find is that's a big communication stock. It's a decent value with respect to the entire sector. Sector trades at 43 times annual earnings. It's trading at 18, right? Now that means price hasn't caught up, but that means it's a better price you're paying for what you're getting. So investors look at, this is old Warren Buffett stuff. If you guys want a book, there's a book, it's called The Intelligent Investor. It's like the holy grail for a lot of value guys, Buffett guys. It was written by Benjamin Graham. Old book, 800 pages. It's a tough read, but it'll go through all this type of stuff. I do want to bring up here, and this is, I think, a worthwhile conversation at this point in time. Sometimes valuations can just run rampant, and it's not so important. Like if you were asking yourself, why are people paying $2,000 a share for Tesla? It's all hype. I mean, there's no other reason. They're paying so much. Guys, look at this. This is a, let me see. Can I bring this in focus? All right. Do you guys see Thinkorswim now, or do you still see a monitor? Just the
Guru Focus thing.
Guru Focus. All right. I didn't show the whole screen. Let me show the whole screen. I usually.
Now it's motorbikes.
Oh, actually? Oh, sorry, guys. Give me a sec. All right. I didn't mean to do that. I'm trying to buy a new one. That's why I was doing research. All right. Tesla Inc., right? Their price has exploded. You see Thinkorswim now, right? I think, hopefully.
Yeah.
Okay. $2,000 a share. They're trading at an 796 PE ratio. Almost 800 times what they earn in a year. Ridiculous. Absolutely ridiculous, right? It's a lot of hype built in versus, let's say, an Apple, sorry, I can't spell, AAPL. They're still exceedingly high, but they're only 35 times, right? So this is a much better value for what you're receiving. There's a lot more meat on the bone, if you will, than a unproven, in many respects, you know, you might hate me for saying that, you know, car company that a lot of people have a lot of ideas for and what it'll do, but maybe it'll come true, maybe it won't. Now, in my opinion, all of this stuff is really cool if you're an investor. It doesn't mean jack squat if you're a trader. This is what I'd do if I was trying to decide if I'm trying to buy Apple or Tesla as a long-term investment. If I'm trading it, guys, realize that everything's tradable. It doesn't matter, right? It could have exceedingly high valuations. It could have valuations in the toilet. Doesn't matter. We'll make money on it. So I do want to make that distinction. Traders don't do this. Only time I'd care about this is if I was in a position for over 6 months. Personally, that's my ideas. If I'm going to hold something for multiple months, I care about this. If not, I don't. And remember to always compare things to like kind. So again, go to the sector, go to the industry group, right? So, and then eventually write this down, guys. PEG, it's called PEG ratio. That's what you want to do when it's cross-sector analysis. So it's price to earnings relative to growth. And this is highly important because when you start looking into telecommunication stocks like an AT&T, they're not going to grow like a Tesla. I'm sorry, they just won't. So you have to say, hey, maybe it's a decent price today, but a decent price with no growth expectations is different than a decent price with high growth expectations, right? So that's going to kind of be the next step. But again, most of this doesn't matter unless you're a long-term investor. Traders don't care.
Well, thank you, Jake. And so going back to like what Jake just said and what I said earlier, the longer you're going to hold on to the stock, the more the fundamental analysis matters, right? So, if you're planning on, buying shares of a certain company to hold on to pass on to your grandkids and your kids' kids and whatever, then you need to do more research and understand the fundamentals of a company. The lesser you're going to hold on to the stock, the less you need to know. It's going to be more the technical part of it. But it's important to talk about this, and it sounds boring, when you're just listening to just talking about just these words and figures and all that stuff. But it is an important part when it comes to investing, because the more you know about the company, the CEO, how it's being run, whether they're making money, losing money, whatever, all those things matter the longer you plan on holding on to the stock. Now, when it comes to trading, I could care less who the CEO is, where the company is based out, what they're planning on doing in 5 years, because I don't plan on being in that trade for 5 years. I'm only going to be in it for a short time. So, so the technical analysis then comes to play. But it's important to kind of go through this, as boring as it may sound, and just so you guys can have a basic understanding and knowledge of this stuff, because it does matter. At some point, it does come to play. And it usually comes to play when you're not prepared for it. So it's better to know and just have it in the back of your mind than not knowing. Does that make sense? Any questions on the fundamental analysis?
Yeah, I also want to make sure that I understand this. So like when I've heard y'all saying like investor or the other word. So like if it's an investor, you're saying that like if I'm thinking as an investor, then the fundamental analysis is what I want to look at more. And then the other one, a trader, right? That's the one that, what's that?
Trading? You become a trader?
Trading.
Mm-hmm.
That's when I look at the technical analysis, correct?
Yeah, well,
I look at all of them, but I look at that.
Yeah, even the investor will look at the technical analysis as well. They'll look, because you don't want to buy a stock that's going down, right? So you still look at the technical analysis, but they weigh heavy on. They do a lot more due diligence and do a lot more homework or research per se on the company before they decide to buy. Right, like the technicals is like the last deciding factor. They go through and do the research and all that stuff, and then get to the technicals where they decide whether it's the right time to buy.
And they also, Jay, line up on time frame. If a company is profitable or not profitable, that doesn't mean they go up or down tomorrow. Those two things are totally independent of each other. If a company makes money or they don't make money, that'll determine if investors stay with them over the next 5-10 years. So those types of things very matter, have a lot more weight in the long term. Profitability, sustainability, are they taking on too much debt? Are they setting themselves up to grow? And then day to day, things like news announcements, earnings announcements, technical chart patterns will have far more weight on how price moves.
Yep. And that leads me to the next, that was a good question. That leads me to the next point is, the type of trader you're going to end up being. So just, write like on if you're taking notes, and just, title this, types of traders, if you will, but you kind of know that that's what we're talking about. So, going back to that, investor versus trader, right? You have your short-term traders, and then you have your long-term traders, right? Or investors. So the short-term traders would you be considered to be a day trader. So the one type of trader is called a day trader. So write that down, day trader. And a day trader is a person who trades but does not carry any positions overnight, meaning they're in and out of the market and they're done by the time the market is done. doesn't mean that they spend 8 hours, trading all day long. They just don't carry any positions overnight. They buy and sell and they're done, close their books. Their account is reset to zero, meaning that they don't have any positions open carrying through to the next day. So they'll either spend, a few hours, a few minutes, or whatever. They have a predefined, specific amount that they want to make that day. If they make that much money that day, they're done. If they lose a certain amount, they're done. They're very disciplined when it comes to actually how they go about their process, right? People think that the day traders are the most riskiest types of traders that are out there. Actually, they're not. Right, they're the most conservative because they don't want to carry any overnight risk. If you buy something today, and you're waiting for that trade to to the stock price to go up, and it takes a week or so, you're carrying that risk on every single day. Whereas a day trader literally is like looking at that specific trade for this, for a certain time frame, and they're in and out of that trade within a matter of minutes or hours, and they don't carry anything overnight. So when we start getting into the different candlesticks analysis and how we look at candlesticks, a day trader, just put this in your reference, will use what we call an intraday time frame. And what that means is that, kind of like when you guys see me pulling up those charts and we look at the candlesticks and each candlestick represents one day, they actually break it down where they go intraday and they're looking at either a 5-minute chart, a 15-minute chart, or even sometimes a 3-minute, even a 1-minute. It just depends on the kind of trader that they are, but they're within that candlestick of the day. So Jake, do you want to run that, or you want me to show that real quick?
You could show that, but I have a question for you, Em. If you're day trading, what time frames are you looking at?
I'm typically looking at 5-minute and 15-minute. Okay. If the market is really moving, I might go down to a 3, but I try. That's too fast even for me. So I seem to, and I know we said don't have any emotion, but I seem to have a little bit of emotion when I'm looking at a 3-minute versus a 5-minute. So yeah, I either do a 15 or 5. So if we're looking at, what was a high flyer today? Tesla. So if you guys, can you guys see my screen?
Yeah.
Okay. So, and again, every broker is going to have these tabs where they're located in your specific broker, whichever one you end up using, you'll find it. But this is where the tab is for Thinkorswim. And it has like a drop down where you can select which time frame you want to look at. So the default is always going to be on the D, which stands for daily. And if you want to go down to a different time frame, you can select what you want to look at. If you want to look at a weekly time frame, when you click on that, now each candlestick is looking at a 1-week time frame. So this candlestick represents this week. Today is Monday. This is the beginning of this candlestick. So this candlestick will remain here until Friday, and wherever the price of Tesla will be at on Friday, that will be the candlestick for this week. And then next week, Monday, there will be a new one that comes up. This is the candlestick for last week, and then the week before, and so on and so forth, because we're looking at a weekly time frame. So if you're looking at a day trader will go intraday. That's why it's called intraday, because we're going inside a 1-day candle. So this is a 1-day candle, but now I want to get more specific data about this one specific candle. So now I can go in and say, hey, give me a 5-minute on what Tesla did today. So just to kind of give you preference, just to kind of give you like the big picture, a day trader, right, could have, so the Tesla opened, this is where Tesla closed on Friday. It closed at about 2050, let's call that 2050, right? And you can see here, by the way, this is the price index right here, and this down here is your time index. So whenever when I'm looking at the price, I look at this column right here, and then down here is the time, is your time axis. Also, and you guys, you can't, you'll see it when I move the mouse around, but right up here where it says the date, it has O, which stands for open, it has the H, which stands for the high price, L, the low, and see close. As I move my mouse, it's giving me the data information for that candlestick that my mouse is on. So if I put my mouse on this candlestick here, this really big red one, it's giving me the information for that candlestick, and it's the 5-minute candlestick for that specific candle. So the day was today at 9:50. It opened at 2069. The high was 2074. The low was 1927, and the close was 1945. So this specific time frame right here, this is that whole candlestick that we looked at on the day, but now it's broken down into 5 minutes. Okay, so a day trader would have looked at this and probably said, okay, I'm going to short Tesla, because it's going down, on this candlestick. That's a long range. If you look at that range, that's $25. I mean, that's $146 in price movement, right? From where it opened at 2069 to where it closed at 1945. That's a move you get in a day, in like a day, let alone a 5-minute candlestick, right? So anybody that was day trading Tesla really would have, taken advantage of this big candlestick right here. So this is what we call intraday. So the day trader is not going to carry, they would have, wherever they chose as their entry and their exit positions throughout the day, by the time the market closed today at 4 o'clock, they were out of this trade and they were no longer holding any positions in Tesla. Whether they made money or not, we don't know, but a day trader is not going to carry they're not going to carry any overnight risk. They end their trade, at whatever they end their trade on, but they're not going to carry anything overnight. Okay, so that's a day trader. A swing trader is the next one.
I do want to say, I don't think anybody should ever start day trading. It takes the highest skill set because you have to be fast. So for example, when I day trade, I build my setups off a 15-minute candle. So if Emily went up on the screen and changed the 5 to a 15, that's my setup time frame. So when I'm looking for my chart patterns, I'm looking for, my pretty little lines to whatever you're going to do on the chart to line up perfectly so that it's an entry. I'm looking here. But then when I'm actually placing the trade, I go down to a 3-minute window. And in that side of that 3 minutes or 180 seconds, I make a decision. And for a lot of new traders, that's fast, right? Go, no go. I got 180 seconds. It's better to start off trading on slower time frames and speed up because it's easy to go faster. It's just like driving a motorcycle, right? Like anybody, you just pull the throttle and you go, right? But speed kills. Speed kills.
Yep. The next type of trader will be what we call a swing trader. And a swing trader typically is going to be in that trade for maybe about 7 to 14 days. So roughly around, 2 weeks, right? Because they're waiting for the actual trade to evolve, right? And they just want to capture a movement. It's a pivot, right? They just want to capture one movement. So for example, if we're looking at Tesla once again, and we'll just use Tesla as an example. Let me see if there's actually a better one. Maybe Apple. Apple is just, they like their charts look identical, don't they? In terms of like how they've just moved up. Let me clear that. So a swing trader would be looking to capture just well, actually, you know what? Just for the sake of not confusing people, let's just keep it on Tesla. So a swing trader is looking to be in a trade for a period of time, normally about 2 weeks, because they want the trade to evolve. So let's say, for example, somebody was looking at Tesla to buy Tesla once it started to go back up. So as you can see here, like this trend, you would call this trend like a neutral trend where it really wasn't going up much. It wasn't going down. It was kind of just like stuck here and, like stuck in this range right here. But when it broke out and started to give you these highs, somebody may have gotten into the trade and they just want to capture that movement and then take profit and exit and then wait for it to reset again and then capture it again. So a swing trader would be somebody who just wants to capture that. Let me change my drawing tool here. So a swing trader is just capturing that move right there and they're out. And then they wait for it to set up again and then they capture that move and they're out, right? So that's what a swing trader does. They look for They look for setups and they just want to capture a movement. And that trade usually takes about, again, 7 to 14 days. So that's roughly about 2 weeks in the trade, right? And they rinse and repeat the same thing over and over again. But they're looking for that setup where they can get in, capture a movement, and get out. Okay, that's what you would call a swing trader. And a swing trader will most likely use a day time frame, but they might choose their entry in a 15-minute time frame. Like they might decide, okay, I'm going to use an intraday time frame to find out where my entry will be, where I'm going to buy the stock, but they still base their day-to-day management on a daily candlestick. Okay. The next type of trader is going to be a position trader.
I also just want to mention, as you guys are writing down the word position, that we're teaching something without identifying it. It's something called multiple time frame analysis. Almost every trader will do this. Is you'll have a base timeline, which is a build window. It's like that's where the setups come from. That's the chart patterns you're looking at. Then a lot of times you'll zoom in, and the reason you zoom in is you can get a tighter control over your entries and exits. So for example, a lot of times you can take less risk in the trade because you might find a support level that's inside of the whole 1 day candle, but it was really strong. So you could put your stop loss a little higher, and you can sometimes even enter a little sooner because, hey, it's breaking this intraday level, get in there. So you can get a little more fine tuning. And then you will typically also go out a time frame, meaning that swing traders will also look at a weekly. And that's to make sure that there's no larger trends that would impede your progress. One thing that you need to remember is like the bigger fish eats the smaller fish, right? So a weekly trend destroys a daily trend. A daily trend destroys an hour trend. An hour trend destroys a 15-minute trend. And it's really easy if you're too zoomed in to not see the little down move be inside of a really big up move or vice versa. So you just make sure you're not going to get squashed. Mm-hmm. Very common.
Okay, so the position trader is similar to a swing trader. They actually just capture like the actual. They capture the So the swing trader captures the pivot, right? They go one pivot. A position trader will go pivot to pivot as long as the trend is remaining in that in the bullish uptrend. So let's say, for example, they're looking at Tesla and Tesla's been going up. They're not. They actually want to just capture pivot to pivot. Like they'll go longer. So they're in the trade longer than a swing trader. They'll look at the daily candlestick, but they'll also probably even go and look at a weekly to see what the overall trend is. So the day-to-day is not going to bother them as much. They're going to look at the weekly to see if the trend is still going up. So they want to capture pivot to pivot, right? And they're in the trade typically anywhere between, I would probably say 2 to 4 weeks.
Another name for this style of trading is trend trading. So as long as the trend is the same, the trade remains. Mm-hmm. As soon as the trend changes is when you get out. Yep. So it's not buying every low, selling every high, just the general gist. As long as it's still going up, keep me in the trade. Yep.
So you can see here on this weekly, Tesla, even though it had this 4 week of just sideways, it was sideways still in an uptrend. So the position trader would have probably still been in the trade, and it's because the trend is still an uptrend. And then the last one that we have is what we call the investor. And the investor is looking to capture the entire cycle. And this is where, when we're talking about looking at fundamentals, if you're going to be an investor and you're capturing the whole cycle, then you want to dive in a little bit more and looking at those companies' fundamentals to get a more of a glimpse of how the company is doing, how it's performing, because you're planning on holding it for a long time. And typically it's anybody who's planning on holding a stock for 6 months or longer.
I would also say I would think about these types of different styles because what Emily's doing an amazing job of doing for you is laying out the different styles that you can fall into. It's like for real estate investors. You know how many different types of investors there are? I have friends of mine that all they do is discount note purchases. That's it. That's fine. I have friends that just lend. That's fine. I have friends that are just landlords that flip homes that do whatever. Doesn't matter. There's so many styles. It's like choose your flavor and then run with it. Same thing here, guys, right? What do you like to do? Do you want to check the market every day? Some people do. They're like, yeah, I want that first hour morning juices flowing. Other people are like, no way. I want to check it once a week on Saturday when I have a free minute. That's fine as well. But I think this takes a lot of self-awareness because I've seen a lot of people in trading, and this is just from all the students I've taught over the years. People will get all excited about, they'll say, what do you want to do? And typical answer is, what makes me the most? And I'm like, well, that's easy. Sit in front of your computer screen all day, every day, never leave, right? That's technically, I mean, you can make more than anybody else, but do you really want that? So I find that if you're realistic with yourself and you're just consistent with what input of time you put into this and marrying that, not saying I want to day trade, saying, oh, I want to do 2 hours a day in the market. That's why I'm going to day trade. Or I only want to check the market every other day, so therefore I'm going to swing trade. Or I only want to check the market once a week, so therefore I position trade. Right? Figure out what you want first and how you want to approach it. Then that'll tell you the style that you are.
Yep. And that could change too. Like, as you're different, as, life happens and, opportunities and time and all that stuff, like, you can change and be a different type of trader. Sometimes I'm all 4 in a day. Sometimes I'm just 1. Sometimes it just depends on what's happening in the market. And I want to actually just say this, when it comes to like, the investor type, an investor will, and if your plan is to buy stock and hold stock for some time, then the ideal place to do that would be in those like retirement type of accounts, whether it's a Roth or an IRA or SEP or whatever. That's where you would do those, long-term positions because you're not planning on getting rid of that stock for some time. This is where now cash flow comes into place. If you own shares of something, now we can start getting into strategies where now you incorporate options and do things like covered calls while you own the asset. But you can certainly be more than one thing. Typically, people start off being one thing, and then as their trading skills evolve, they end up, becoming, day traders or whatever. You might start off being a position trader because of your, you want to, spend a specific amount of time in the market. But then, if time allows you to be home more and you want to learn how to day trade, then you can certainly become a day trader while you're still position trading. So, you can be more than one, but initially, you want to focus on like the one that you see yourself being, hone in on that, practice off of that, and then evolve as you become more, educated and you learn more different, skill sets and all that kind of stuff. And then you can actually add on to that. But I just kind of want to show you big picture where with Tesla. So, imagine, this was today, you imagine you own Tesla, right? You traded Tesla in one particular way or another. You could have been an investor. You could have been a day trader. You could have been a position trader or a swing trader, right? And the outcome would have been different for everybody in that in that category. So a day trader could have gone in and day traded Tesla for a 5-minute, 10-minute, whatever it was, made their profit or loss, and they were out. No emotion, they're in, they're out, they're done for the day, okay? A swing trader who perhaps was looking at Tesla going, oh, well, Tesla on Friday was at this price point, and they decided that that was gonna be their new entry and get into the trade on Friday because they were anticipating that it's gonna continue to go up because, it's been going up. Well, if they got into the trade, hopefully they had a stop loss, but a swing trader, if they were bullish, meaning that they were anticipating Tesla to continue in that trend of going up. Well, this morning it opened. If you look at the time frame of where it opened, right? So this morning it opened and hit an all-time high and then sold off like for part of the morning and then kind of like fizzled off here in the afternoon. So a swing trader, right, may have gotten into the trade on Friday, if they had a target, and this is where we talk about rules being so specific and having a plan before you ever click the buy button. If you had a target already in place, you would have had it automated where you would have taken profit on Tesla when it got to a certain point. And we'll talk about this when we talk about entering trades and how to, how to calculate your entry and your stop loss and all that stuff. And then as Tesla started to go down today, because it did come all the way down to a low of 1927, at some point during this trade, they would have taken a loss, or what we call an expense trade, because Tesla stopped going in the direction that it was supposed to be going. So a swing trader might have gotten kicked out of the trade, because this is where they got in on Friday. It gapped and actually went up and hit an all-time high of 21.29. But if they didn't take profit and they had that emotion of greed saying, oh my God, well, Tesla just opened up and hit hit an all-time high of 21.29. Well, 21.29 is a lot, 21.40 is a lot better than 21.29. I'm going to stay in, right? And then watch their profits get eaten away because of greed, where if they had set that, number already ahead of time and said, this is where I'm going to take profit, they'd have gotten out and called it a day. But again, that's the results of the swing trader. The position trader might still be in the trade, because the position trader is capturing the whole. It's going pivot to pivot, so they're probably in this trade, and also the investor is in the trade because they're capturing the whole cycle of Tesla. So just kind of to give you a what the results may have been for each type of trader that may have looked at Tesla today, and depending on what hat they were wearing, whether it was the investor hat, the position trader hat, the swing trader hat, or the day trader hat, they all had different results out of Tesla today. Does that make sense?
By the way, it's all the same skill set, interchangeable across time frame. Once you learn how to do it once, you can do it any time frame. It's all the same thing.
Yep. So I'm going to leave a few minutes for, I know we went a little bit over, but I'm going to leave a few minutes here for Q&A if you guys have any questions, and then we'll pick this up on Wednesday and continue with technical analysis, so we can start looking at now those candlesticks on a deeper sense. But are there any questions so far?
Emily, when we were talking about the 4 types of traders, you had said first you got short term and then long term. So our position and investor, your long terms. Okay.
Yes.
A lot of times.
So I heard a lot of the.
I was just going to say position and cash flow trading are called the same thing. So if you hear somebody say cash flow trading, it means position trading. You might have said that, but I wanted to reiterate.
Position trader, trend trader, cash flow trader.
Who is that? You. That's not Matthew. That's not me.
Yeah, you're unmuted. Why'd you unmute yourself?
He's not unmuted.
Yes, you did. You hit your space bar.
He didn't hit space.
That wasn't me.
Look,
Somebody did it.
You need to mute yourself.
What? So I've been hearing some of these podcasts, and a lot of them, I know everyone has their own way of doing it, like you said. Some were saying like investing for the long haul. That would be these two, position trader and investor. That's what they mean by investing for the long haul.
It will be more on the investor side, and I guess it also depends on what they define as long haul, right?
Got it.
But for me, the way I define an investor is somebody who's planning on holding on to that stock for at least 6 months or more. Like that's how.
Got it. Right.
Like you're planning on holding on to that. You're not gonna pump and dump it, like buy it today and sell it tomorrow. You're not gonna do that, right? So you're literally looking at it to hold on to it for a while, And for most people, like if you're doing this in a retirement account, until it fundamentally changes, meaning it's not doing what you invested it to do, meaning like let's say they change their overall business structure, right? So you would no longer look to have that stock because it's not doing what you invested in it for. So like for example, I don't know, like GE for what, so GE, for example, let's say they make appliances, right? But then and the reason why you invested in GE is because you like them because they make appliances, and you know that appliances are in everybody's homes, and everybody has to have a fridge and a dishwasher and a microwave and all these things, right? And then out of a sudden, out of the blue, they say they're going to get into the pharmaceutical business, right? Well, if that's not why you invested in GE in the first place, would you then hold on to GE, or would you then make a decision, okay, I'm going to find another company that makes appliances and now no longer hold, so if you're doing this in your retirement account, you're not planning on getting rid of the stock unless it's either going down to the point where it's taken a loss and it's gotten to where your rules are in terms of it's gone down 5%, 10%, I'm out, or whatever your rule base is, or it's changed what it does fundamentally.
Okay, cool. We're looking at Apple stocks, and I was reading somewhere that Apple did this thing recently. I don't know if I'm understanding this right, but I don't know, like it was like $500 a share, and then they like changed it to whatever it was now, like 100 or 200. I don't know if we're gonna talk about that later. If we are, then cool, I'll just wait. But if not, what does that mean? Like,
we actually kind of talked about it, and actually I think I posted the video in the investor party. So if you want to go back to, I kind of did a video explaining it, but what it is, it's a stock split where their price is, what is their price? What was Apple's price as of today? I think it was
515
500.
was the high. It closed at 503.
503, right? So when I did that video, Apple was at 400. So just change the numbers, but basically what they're doing, and I think that was happening today, if I'm not wrong, or is it on the 31st? I think it's on the 31st. But anyway, so what they're doing is what's called a stock split, and so if you already had a share of Apple, it's a 4-to-1 stock split. So all it means is that you're going to have an additional 3 shares of Apple, but now the price of the stock of Apple will now be reduced so that it's an even amount. So when I think I did that, so if Apple is sitting at 500, then that means each share would now be like $125 if my math is correct. So you would still end up with the same amount of capital. So if you have $500 invested in Apple, you would now have 4 shares at $125 a piece. So the dollar amount will still be the same, right? So when they do the stock split, it's really to just allow a lower entry level for somebody that might feel like, they're out of the game and they can't necessarily trade Apple. So it doesn't change anything about the company fundamentally or anything like that. All it does is just create a new entry price for people that might have not been able to afford to buy, Apple at 500, if that makes sense.
cool. So like, for instance, Tesla, which is like, thousands of whatever stock. So like if they were to do that, then like it'd probably be a good idea to, right. Okay.
Yeah, well, and they're doing it too. They're doing it at the end of the month, I believe. I think the 31st. I think they're both doing it the 31st.
Well, shit, I gotta.
Yeah, they're doing it as well, but again, it doesn't add to the company. So realize it just changes the number of the item, right? You have the same amount of things, you have the same value, but it's kind of shocking how much it's run on non-news, because all they said is we're going to use fancy financial math, and then the stock rallies like 40%. It's ridiculous.
Right. So
the craziness in the market.
Yeah, it's not a determining factor as to whether that's the time to buy a stock when it does a stock split. All it does is just allow an entry point. So if you were somebody who was eyeing Apple, and you were like, well, yeah, based on my portfolio, I can't afford Apple at 500. If I have $10,000 and and I'm trying to allocate a certain amount of capital to Apple, I can only buy X amount of shares, right? Well, this just allows you to buy more shares at a lower price.
Got it. Because there's no guarantee it's going to shoot back up to whatever, 2000 or whatever, right?
Yes. Okay. All things being said, Apple is sitting at 500, and they announced their stock split a month ago, and it was at 400. And they've done this before. They've done this 4 other times. The last time they did a split, it was at $700. So they did the split back in 2014, I believe. And at the time, I think it was a 7-to-1 split. And the price came down to like about $80. So from 2014, Apple's price has gone from $82 all the way back up to $500. So not always the case, but again, it all depends on the fundamental of the company and how it's run, whether it's making money, losing money, and if the investors are happy with their earnings, and all those things come into play in terms of what drives the price up, and also the market in general, right? All things, and the tide move all ships, move the ship. So all those things play into factor, but the stock split itself does not, determine whether the stock price is going to go up or down. It's just they're rebalancing their their sheet, if you would say, like they're just rebalancing their account so that they can just allow a new entry price point for people that might have otherwise been out of the game and they couldn't trade it.
Cool. Thanks.
Cool. And I know we went a lot. We did a lot of information today, so I know it's a lot, and I know your brains are probably fried.
Wait, I got something I was gonna maybe share. Well, I'll ask you, Emily, though. It's kind of a sneak. Are you doing technicals next time?
Yes.
Okay, it would be a sneak peek to technicals. It's kind of high level, but it's summary based. Do you guys want to do that, or no? Are we just quitting? Doesn't matter to me.
I'm cool. I'll listen.
They're all muted, so yeah. Okay, they're all in. Except
Okay, what I'll do is I'll show you a screen and then you screenshot it. How about that? And then it'll be a good reference for next time. There you go. Let's do that. I made a kind of a cool little thing. Guys, I made this sheet for you. There's only 3 trades in the market: a retracement, a breakout / breakdown, and a fade. Only 3 trades. So if you're trying to trade, you could 1, 2, or 3. That's it. The stuff isn't really that hard, guys. It is far from rocket science. It's like hillbilly science. So you buy the green circle and you sell the red circle in this picture. That's all you do. That's it. So you see it going up and then down and up and down. You say, wow, it's like waves in the ocean, right? It just keeps flowing up. And then you buy it here because it's at a low. It slows down. It rips up. And then you sell it at the red. Then you make money. Right? Now, people who do that are retracement traders. You can also wait till it breaks through a ceiling. That's the yellow circle. Yellow circle is like level 2. You don't make as much money. You can see it's only from the yellow to the red circle. You're trying to make money. You have half the distance. So I don't necessarily recommend starting there. You could do those trades as well. And the last type of trade is trying to catch it when it falls back. So it's the red, selling red to buy green. That's it. There's only 3 trades.
Cool.
You buy the green and sell the red. You buy the orange, you sell the red. You sell the red, you buy the green. That's it. That's all we do. And we do it a bajillion times over and over and over again. That's it. So now we're going to talk about what this looks like with candles and everything else, I guess, for the next go around. But I want you to realize, guys, this stuff isn't really that hard. You just buy the green circle and you sell the red circle. And if you have this little kind of cheat sheet, it'll be a reminder, you know, kind of how it works. But it just, and you can see the green circle repeats, right? So what happens is the red circle falls to the old yellow circle and it becomes a new green circle. Cycle repeats over and over and over again until infinity. And that's all we do. I really wish it was more intellectually challenging. It's not. It becomes very, very repetitive very quickly. So that's all I wanted to say. So it's easy, and I say that because it's easy to get overwhelmed. We're talking about P ratios and all these numbers, and I never use that, guys. Unless in my investing accounts, I kind of care. Yeah, but when I'm trading, I just buy greens and I sell reds. I buy greens, I sell reds, I buy greens, I sell. That's all I do. And that's it. And if you know that, you're good.
Yeah, it's fundamental analysis is one of those things where it's just nice to know, but if you're not like, you know, going to be doing any long-term investing, it's just one of those things like, yeah, we just have to know about it. When it comes to like trading and you're doing the swing trading, day trading, position trading, you know, the fundamentals really doesn't matter, but it's one of those things where we still just have to talk about it because you cannot ignore fundamental analysis. So I know it's it's probably like the most boring part of when it comes to learning about all this stuff, but it's one of those things that we just have to touch on and cannot ignore it because it does matter. But next Wednesday will be the more the things of like what I normally do and what Jake and I typically do. So this is going to be the fun stuff of like how we actually go in there, look at pictures and technical analysis, figure out what we're going to get in, you know, and all that stuff. So that will be the fun stuff is now on its way. So but we just had to get past the fundamental side because it's important to know these things, even though you never end up doing it, but it's good to know.
Let me ask you guys, do you guys think you could be capable of buying green and selling red? Do you think you could do that?
Yeah.
1 + 2 = 3.
Yeah. I mean, that's all it is, guys. I'm telling you, the barrier to be a successful trader is very low. I'd say the difference, though, is, again, having a good system in place and managing emotions. That's where it gets hard because what happens is when it gets to red, you don't want to sell on red because you think red's going to keep going to infinity, and it doesn't. So that's the hard part. But besides that, guys, this game is so simple. That's all we do. So I wanted to get that context because it's really everybody thinks it's so challenging. No, I really wish it was a little more challenging because then I'd feel like smarter to tell people I'm a trader. You know, it's like yeah. I won't go down my analogies, but you guys get the point.
All right, guys. Well, I know we kept you guys here a little bit longer than we anticipated to, but you guys are engaging and you're asking questions. So I want to make sure that we are making sure that you guys are just following along. And again, I know it's the fundamental part is probably like the boringest part of this, but it's one of those things that we just have to talk about it. So if you guys don't have any questions, then we will wrap it up. If you haven't already opened up an account, looking to get into getting that done this week, because we're going to start getting into, once we start getting into technical analysis, we're going to start actually like paper trading and actually starting to do like order entries and the types of orders. So I want you guys to practice those things. So definitely, look into opening up an account if you haven't done so already. Don't worry about funding the account. You don't have to put any money into it. I just want you guys to get to the point where you have that paper trade part of it, where you can start to just click buttons on the virtual side of it.
I would also challenge you guys to click the buttons. You realize that there's a reset button in those accounts. So if you blow it up and it gets just the computer fries, you press reset and it goes back. So go for it. I mean, you can't break it. Just click every button. What does that do? Click, 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 click. Yeah, that's the best way to learn, in my opinion.
Yep, just get in there and start driving, but not the real car, the fake car. Like go in the go-karts. We're driving the go-karts. We're not driving the real cars.
Drive the Corolla. Not the Tesla.
We're doing the bumper cars. All right, guys. Well, thank you for joining us tonight. I really appreciate you guys. And if you have any questions, you can always shoot me a text or send me a message on the app, and I will.
We'll get a Facebook group either built out tonight or by tomorrow. So if you don't have your Facebook link on your investor party platform profile page, please put it on there so we can get that all taken care of.
Perfect. All right, guys. Well, have a great night.
Wait, well, before you go, I do have some announcements. I did stick on and for everything to make sure I did my job. Thank you guys for your patience on the children. Let me tell you. Let me just share a little story, children. When I started this house with the idea of having broken homes fixed by broken hearts to help LGBTQ homeless young adults. First of all, I never thought I'd hear the word hooker thrown around so frequently in my entire life. That was a surprise. I also severely miscalculated the fact that gay boys don't like to get sweaty. Therefore, having them do manual labor for a flip was very much so like taking a crocodile to a dentist. I need to get some lesbians in here. Do you know any lesbians that need a place to stay? Just send them over. We're going to take them all. It's going to be fine. The bigger the bullseye, the better the hammer. It's fine. It's fine. That's great. Second, but also please make sure they at least know how to basic hygiene. That's what I want. Second thing, they are not scarves. They are tablecloths. Leave them alone. Oh my God. What did I just say?
I don't know.
Also, I've never seen so much porn on cell phones being passed around back and forth between these 18-year-olds until I started. Well, I do know Nelson and Bo, so different story. All right, so.
Oh, I missed the good stuff.
All the good stuff. Oh, sweet Jesus. All right, so quick announcements we want to have. So make sure you mark your calendars. You are supposed to have class here on Mondays and Wednesdays from 8 to 9:30. The only exceptions are going to be Labor Day and Columbus Day. We do not have them on those Mondays, so you do have those off. So just make sure you mark those calendars for you. You also do have your Friday market updates at 3 o'clock with Emily. Well, right now you guys are learning how to trend and see what's going on, how to read charts and graphs and technical analysis and pretty much anything that Emily wants to share with you and Jake likes to enhance. So just come on and he's like, oh, I'm looking up now. There you are. All I see is your hat. It's very like, you look like such a bro right now. Like, hey, but I think you should be on like a skateboard with a doobie in your mouth. I love trading. It's good times. So that's also Friday at 3 o'clock. Be here. Emily runs the first half of that, and she's my favorite part of the week. So come on in. She and I both hold our tongues very, very well. On your investor party platform, please make sure you have things updated for your bio. We're going to start doing challenges in about a week. I've got a couple things I'm planning. It'll be run by Emily. It might be a week and a half. But this first part is really kind of, well, boring. Then we start trading it because it's a lot more fun. So, but we need this foundational thing first. So what I'm going to do is I'm going to start making this interesting by having. Lord, it's Jacob. I know it's been a long time since we've spoken. Once I have that cursed you out after I hit my pinky toe across that bed frame again. But listen, it's been a very long day. And my nerves are about to. But I'm out of vodka, Lord, so you have to help me a little bit here. I need you just to give me a little bit more patience or some Xanax. One of the two.
You got some water?
Dude, yes, if I could just give me one miracle and let me turn water into anything with a proof, and I would be ecstatic. I could suck the alcohol out of a bottle of scope right now. Anyway. We're still recording.
Yeah.
Yeah, it's just, we're not live on Facebook. No, this is private. We don't have this live on Facebook. Okay. So make sure your stuff is updated so I can start making these challenges. They're going to be a lot of fun. We're going to be mixing ages and age ranges, and we're also going to be doing some actual research on the Federal Reserve. That's because I want you guys to understand what money is, because a lot of the fear that you guys have as investors, if you don't have it, you're going to have it, is because you don't understand money. And most of that's because you don't understand the history of money. Now, one of the books we're going to be reading throughout Investor Party, not just here, but throughout Investor Party is going to be a book called The Creature from Jekyll Island. If you have not gotten it, which you haven't, I recommend going onto Audible and downloading it. It is a very long book. So go ahead and just start listening to it. I want to get through the intro and the first phase. Just chat part one before this section, before our time together is over. It's very enlightening, gives you an idea of what is money. When Emily and Jake and I talk about fractional reserve lending, what does that mean? How do we do it? We're gonna make some stuff like that happen. So just go ahead and download that on Audible, start listening to it. It's also on YouTube, I believe, but just go ahead and start. It's a very, very long audiobook. So we're just gonna pace it. The thing is, it sounds crazy until you get to the end of the book and it talks about what happens next. And it actually talks about living through a global pandemic. So it's kind of creepy. G. Edward Griffin was one of the individuals that also predicted the 2008 global economic crisis. So make sure you know what's going on. Child, I'm working. So.
You can't resist.
Yes.
But what am I forgetting? We're going to be starting Real Estate Survivor Season 2 in October 1st. So if you've got friends who are looking at getting involved, we're going to be starting it in October. So take a look for that now. We have a guest tomorrow. Oh my God, Emily, you would love this. So tomorrow, my guest that's coming on the show is one of my favorite human beings. She, her name is Parminder Batra. She created the... She has a business that she started as my student. I saw her start this like brilliant idea, and it's turned to a multi-million-dollar business over the past 7 years. And you can see her growth. Now, she is female, Canadian Indian living in America, who is the CEO of a tech company. How many more minorities do you have to make here? I mean, seriously, if you learn about grit and emotion and control, come to that meeting tomorrow. It is going to be so inspirational. I hope you guys love it. It's awesome. You'll love it. Just be there. You'll love it. Okay, just be there. They actually are going to be taking their stock. Well, I shouldn't say anything yet. It's what that'd be called insider trading.
No, Jay, you'll have to finish stock before you get into Real Estate Survivor.
Yes. Part of the thing we do here is you have to learn how to finish one course into another and apply it. Now, one thing you might be able to do is you might be able to get your husband into Real Estate Survivor.
Who has a husband?
Jay has a
Good
husband.
point.
Yes. So you're able to get other people involved that are not yours. Now, something you're going to learn as well as we go through this program, you'll be able to invite up to two individuals that you are not related to. So you do not share one of the 3 Bs. You do not currently share a bed, a bank account, or blood with one another. Like that, Jake? It's all for you, buddy. Blood, bank account, or bed. You do not get to share one of those 3 things with them, then you can invite them to the party, right? Do you remember saying that one day, Jake? We were rooming together.
Said it all the time.
Yeah, it was awesome.
Yeah, that was in my presentations. You stole that line, but that's all right.
I did. I give you credit all the time.
All right.
And now it's my show, so I'm taking it.
Take it. It's yours, bro. It's yours.
The other Jacob gave me that. I love it. That was great. So you can invite them into the party. After you guys are done, we're going to be going into options if you completed the right amount of trades, which Emily and I are going to determine together. You'll be able to graduate to the next level. So that being said, your homework tonight is we're creating the Facebook group. Make sure you say hi and we'll see what's going on in there. You also want to make sure you're being active in the investor party tribe, okay? Say hi to each other, get to know one another on those platforms. You want to make sure you've set up your paper trading account if you've not done that already. And you want to start listening to the Creature from Jekyll Island so you have an understanding of what the history of money is. Is that enough for everybody?
No, we need more. Oh, sorry.
Be quiet, Eric.
That's enough. I can remember.
What was that? What was that other Jacob? Number 3?
I said, be quiet, Derek.
Bo. Hi, Bo.
All right. I really believe that's everything. I swear to Cal, I'm going to. Emily, this is yours.
He's just mad. He's mad.
Those are my table coverings for our outside patio.
That's your map of the U.S. scarf. Don't play dumb.
That is not the map U.S. scarf. Hey, where does you see the United States on that thing? That's just a sarong. I got it in India.
Where's the U.S. scarf?
It's hanging in my closet with the rest of my scarves. I use my face covering since
Matthew,
there's not the
go grab
burqa.
that one.
Okay.
Okay,
All right,
it's too late.
I'm done. I'm going to.
Good night.
Love y'all.
Bye, Bo.
Love you.
Bye.
Love you all.
Bye,
Bye.
Pamela. Robin, I'll see you
Bye,
later.
honey.
We'll get notes typed up. It'll be in the class notes and homework section. So
Let's go.
find them there tomorrow.
Oh, sweet Jesus.
Oh.
Love y'all.
Oh.
Bye, you guys. Have a good one.
Night.
Bye. Thank you so much.
See you tomorrow at 3.